If you have to get one thing right in the market, is it the dollar dynamics and the dollar direction? And so is it what the Fed does next?
What the Fed does next matters. I think the most important thing to get right at the moment is the direction of the stock market. We've seen severe panic really over October into November. We track 4 different measures of investor sentiment and make a combined indicator. And it's what we saw in October was the 10th most extreme reading since 1991, which is quite a lot of crises. So there's been some panic. I think investors are going to have to think about what could go right rather than what could go wrong for stocks. And when we've been buying during the dip, we're not sure which way the dollar goes coming out of it. Because on the one hand, it really kind of depends whether the Fed blinks in response to the panic. Usually when you get a financial market panic, policymakers will respond to it, and that helps give you the recovery. So far we've seen a Chinese response from Xi, but we haven't seen the Fed response. We may be about to get it, which could mean you've got a recovery with a weak dollar. If the Fed says, actually, we're going to keep raising interest rates, then you'll get a recovery with a strong dollar.
Right. What do you think they should do?
I think they'll probably signal some kind of pause. I think they were unable to do it in October because President Trump blamed them for the sell-off, which made it very hard for them then to respond to the financial market stress by saying some soothing words. Now the midterms are out of the way. It's easier for them to sort of say, oh, they're a bit more data dependent. The housing data's softening a bit. I don't know. I think they may well raise rates in December, but I think they'll signal that that may be it for the time being.
Stefano, do you need monetary policy to normalize? Because that would make your job a hell of a lot more interesting if you suddenly have, this cheap cash that's been there for 10 years really being taken out of the equation. Does it mean that we'll be left with, zombie companies to restructure?
Well, certainly with the interest rate going up, we expect some of the most leveraged company to face some difficulty, and therefore going back to potentially normalized situation, because now we are at an all-time low in terms of restructuring. So we expect that to pick up in the next months.
But again, then you have companies actually needing restructuring or going bust. That actually means that it could engender some kind of panic in the markets.
Yes, I mean, you've also got some stress in the credit markets at the moment. Everyone's watching GE very closely. But my expectation is that the US economy is going to stay strong for another 3 quarters or so because of the stimulus in the pipeline already. The Chinese are stimulating as of now, and they always overdo it. The GDP numbers won't move an inch. But the real economy will actually recover quite strongly, I think, in China. So I don't think the recession risk is with us at the moment. It's the recession risk that really brings a lot of corporate failures. But I think it's building for 1920. Because if you do get another burst of activity, the Fed will raise rates further. We may get to a 2% real interest rate, and that's usually been the trigger for a recession. And then I think we watch housing, and we could see a recession in 2020. So my feeling is that we're right to be thinking about it, but it's a little bit too soon. And in that timescale, something can go right rather than something going wrong. And for example, the drop in the oil price could take some of the inflation out of the system and stop wages from rising for a while. That would be quite welcome if that happens.
Stefano, when you look at regions across the world, where do you see the best business for you guys right now?
Well, right now, certainly United States is really on the high side. We see almost every single sector to be doing well. We see some softness in some part of Europe, including in Germany. We also saw that U.S. has been acquiring much more from China ahead of the trade the trade difficulties. So we might see some slowdown in the very early months of 2019. But I would agree that if there is any mild recession, we see that more in 2020 than in 2019.
Trevor, we have a great markets blog, which I'm sure you follow from time to time, Bloomberg Terminal. Today, happy Thanksgiving to all of our American viewers. We're asking what traders should be thankful for this Thanksgiving. What is it, volatility or something else?
Well, I suppose traders should be thankful for volatility. I mean, I mentioned our sentiment indicator that we look at. We've tested that going all the way back to the early 90s. And what traders should be doing when markets are distressed is closing their eyes and buying. Most people, when they see the red on the screens, close their eyes and sell. But you should be looking on the bright side. And even if something actually very bad is happening and a bear market is starting, the initial human reaction is to overprice it. So close your eyes and buy.
There you go. Close your eyes and buy.